Welcome back, guys. Ben here, helping you financially engineer the type of lifestyle you've always wanted. In today's video, we're going to be talking about crypto taxes. Now, there's a lot of rumors and myths surrounding crypto taxes, so we're going to go over pretty much all of the basics of crypto tax to help you get ready for all those year-end statements and filing procedures. Now, I will throw out there the standard disclaimer that I'm not a certified CPA, so as always, consult your own professionals. I'm just a nerd that loves learning about finance and finding ways to save money. So I'll actually go out and read IRS tax code for fun, because if it helps me find a loophole that saves me money, then that process of saving money it's almost like a game to me. And to me, that's fun. All right, so let's dive into it. Now, the rules are going to be based off the US tax system. So if you're watching elsewhere in the world, things might be slightly different for you guys, but more than likely, many of these rules will still apply. So first off, is crypto taxable? Yes, absolutely. In fact, cryptocurrency is one of the IRS's hottest topics this year. They have enlisted help from blockchain analysis companies to unleash Operation Hidden Treasure. They're going to be actively looking at blockchain data to uncover individuals trying to hide their crypto gains. So make sure you guys are reporting this stuff, because if you don't, you could easily get busted for fraud. So let's run through a few scenarios. Let's say that you bought one Bitcoin earlier in the year and you still own that Bitcoin today. Will you be taxed on that, even though your Bitcoin is worth significantly more now than it was when you bought it? No. You will not be taxed because you haven't sold your coins. All you have at this point is unrealized gains. Even though your Bitcoin is now worth significantly more money, you won't pay any taxes until you actually sell and get rid of that Bitcoin. Well, what if you bought a Bitcoin and transferred it to a different crypto wallet? Maybe moved it from an exchange like Coinbase Pro over to a cold storage wallet. Will you be taxed? No, because once again, you haven't sold that crypto. You still own it. You will only be taxed on any gains or losses once you no longer own that Bitcoin. So only when you sell or otherwise no longer own that Bitcoin will you have to pay taxes on any potential gains. Now, here's where some people try to get creative and say, well, what if I don't sell it? What if I just trade my Bitcoin for a different cryptocurrency like Ethereum? I won't get taxed on it because I never sold it. I just traded it for a different crypto, right? Wrong. The IRS doesn't care that you never redeemed your Bitcoin back into fiat currency. As soon as you got rid of your Bitcoin and did some kind of value conversion with it, they treat that event just like a sale. So it doesn't matter if you use a DEX like Uniswap to trade one crypto for another, the IRS treats that as a taxable event. Same thing with trading and converting your Bitcoin into stable coins. It doesn't matter what creative method you try to use. If you owned a cryptocurrency and then in one way, shape, or form, now you no longer own that crypto, that created a taxable event. So how much are you going to owe in taxes? Well, let's just say that you bought one Bitcoin a while ago at, let's just say, $10,000 per coin, and today you sell it for $60,000. So you made some money and you're going to get taxed on your profit. And to calculate your profit, you're going to use your sales price of $60,000 and subtract from that what you originally paid for the coin, sometimes referred to as your basis. So in this instance, it's going to be $60,000 minus $10,000 is a $50,000 profit. And so you're going to get taxed on that $50,000. From there, in order to figure out how much taxes we'll owe, we need to determine if our profit is considered short-term capital gains or long-term capital gains. And for that, it's simply a matter of how long did we own that particular Bitcoin before we sold it. If we own the Bitcoin for a relatively short time, defined as 1 year or less, then we will owe what's called short-term capital gains. If we own the Bitcoin for a long time, defined as anything over 1 year, so 1 year and 1 day, or longer, then we will owe long-term capital gains. Now, short-term capital gains kind of suck, and you're going to be taxed at your ordinary income rates. These rates depend on your total earned income for the year, and on the low end might be taxed at 10% all the way up into the mid or high 30s if you make a lot of money each year. Now, long-term capital gains, on the other hand, are much more favorable and are taxed at either a 0% rate, 15% or 20% depending on your overall earnings for the year. At an absolute worst, it's still a significant tax savings to only have to pay 20% in taxes as opposed to maybe 37% or more for short-term capital gains. So if you've owned an asset for close to a year, it may be worth holding on to it a little bit longer to get those more favorable tax rates. So what happens if you trade one crypto for another, maybe from Bitcoin to Ethereum? Now, we've already established that it triggers a taxable event, but how exactly does it work? So the way the IRS is going to calculate this is at the exact moment that you made that trade, it is going to do a little pretend, a little make-believe, and it's going to separate these transactions into two parts. First, it's going to pretend that you sold your Bitcoin for dollars. So it's going to take the fair market dollar price of Bitcoin at the time you made the trade and use that number to determine if you made any profits or losses. Then it's going to turn around and use that same number and pretend that you bought Ethereum for that same dollar amount. So let's go back to our original example and say you bought one Bitcoin a while ago and now today you trade that Bitcoin for, 12 Ethereum. So for tax purposes, it's going to pretend like you sold that Bitcoin for dollars, and we'll just keep the math simple and say that at the time you traded it, that Bitcoin was worth 60,000. So 60,000 minus 10,000 that you bought it at, you made $50,000 in profit that you would be required to pay taxes on. And then the IRS completes the transaction by pretending that you used the $60,000 in fiat that you got from selling this Bitcoin to turn around and buy those 12 Ethereum, which gives Ether a fair market value in this case of $5,000 per coin, which will then be the tax basis or the price you bought that Ethereum at for when you eventually sell your Ether later on down the road. So what about crypto mining? How is that taxed? Crypto mining is taxed at your ordinary income levels. So every time you get rewarded with crypto mining and earn 0.001 Bitcoin, which is worth, $100 or whatever. So when that 0.001 Bitcoin hits your wallet, from an IRS perspective, it's no different than if you had worked your regular 9-to-5 job and earned $100 or whatever that 0.001 Bitcoin is worth at the time you earned it. Now, you're going to have to pay taxes on whatever the dollar amount of the Bitcoin was worth at the time you mined it. So what about if you receive some kind of interest on your crypto? Maybe you have it loaned out to a company like Nexo, Celsius, or Crypto.com and you're earning interest on it, or maybe you're staking your crypto on chain. However it is that you're earning interest on it, it really doesn't matter. Either way, it's going to be taxed just like our previous mining example. You're going to need to pay taxes based on the fair market value of the crypto at the time you received it. So what about if you have a credit or debit card that gives you crypto rewards like the BlockFi card or the Crypto.com debit card instead of a traditional cashback rewards card? Now, here I need to throw out a major disclaimer and say that the IRS has not explicitly ruled on this question. So nobody is 100% sure on how to treat these cashback rewards for tax purposes. However, the general consensus among every CPA that I've personally talked to is that passive cashback rewards from your credit or debit card is not taxable income in any way, shape, or form. And this is similar to normal credit cards like the Citi Double Cash card that earns a flat 2% cash back. That 2% cash back isn't treated as taxable income because from an IRS perspective, it's not income, it's a rebate. Almost like when you use a coupon at a store to save some money, that money isn't taxable. However, it's also generally agreed that any sign-up bonuses that you get from these companies is a taxable event. So for example, I think Celsius gives like a $50 worth of Bitcoin after you open an account with them and transfer at least like $400 worth of crypto into your Celsius account. That $50 bonus would be considered taxable. Same thing with a sign-up bonus on a debit or credit card. That initial sign-up bonus that you get, maybe, $100 worth of Bitcoin or something like that, as long as you spend, maybe $500 within the first 3 months. That $100 worth of Bitcoin would be a taxable event, but then any passive rebates and rewards like a 1.5% cashback would not be considered taxable income. So what about crypto losses? While the crypto bull run has been friendly to a lot of people, sometimes you'll lose money too. As anyone knows who tried to buy into the Dogecoin run when it was climbing to well over 70 cents per coin. Don't forget about your losses. They're just as important as reporting your crypto gains. The reason being is that your losses are a tax deduction, which can help offset the amount that you would owe from those other coins that you actually profited from. So, for example, if you made a ton of money on Bitcoin but lost a little money on Dogecoin, then you would only owe a medium amount of money in taxes. So don't forget about your losses because they can help offset your gains. Now, thankfully, many tax programs have been feverishly working to develop programs that will properly calculate your crypto taxes for you, so you shouldn't have to worry too much about it. Places like TurboTax will have a section in there to fill out information about your crypto dealings. Additionally, any exchanges that are compliant with US laws will be issuing you a tax form at the end of the year with all of your details on it. If the exchange was not compliant with US laws, which basically involves requiring you to validate your account with KYC or Know Your Customer procedures, this is where you have to provide them things like your social security number, address, photo ID, etc. So for example, for a long time, I had an unregistered Binance account and never provided KYC documents. But in cases like that, I can easily log in and download my entire trading activity into a CSV file, which is sort of like an Excel style document that I can then load that document into my tax software like TurboTax, and then it will calculate all of my taxes from there. Now, if you're using a DEX to facilitate your trades, for example, I use the PancakeSwap platform a lot, then you can go on to Blockchain Explorer like BSC Scan and provide it your wallet address, and you can download your CSV file from there. Or if you trade on Uniswap, you could go on to Etherscan to obtain your CSV file. Either way, just go to the native blockchain. All of them should have like a scanning system where it can automatically pull all reports based on a particular wallet address that you give it. That should give you a pretty good overview of the vast majority of scenarios that you are likely to face. The bottom line is that you are gonna have to pay taxes and pony up on any gains that you have. And if you're thinking about trying to hide those gains and just not report it, then I would not recommend it. First off, it's felony fraud and you can easily go to jail, but also because your chances of getting away with it are relatively low. While most people generally don't get their taxes audited, and so reporting your taxes is almost like an honor-based system, the IRS is actively looking for crypto tax cheats, kind of like a few decades ago when the IRS was actively scrutinizing anyone who was claiming the home office exemption on their taxes. If the IRS is actively looking to try to catch crypto tax cheats, then please don't try to push your luck and hide it anyway. It's very likely just going to end poorly for you. If you enjoyed this video, consider subscribing and give the video a thumbs up for the YouTube algorithm. If you have any additional tax scenarios, feel free to comment down below and I'll do my best to try to answer them. And as always, I'll see you all again next time. Thanks.